You know those stories of epic comebacks, where an underdog completely redefines its game, not just surviving, but thriving to become a formidable force. Well, that's precisely the incredible journey we're charting today with advanced micro devices, better known, of course, as AMD. This isn't just about a company, it's about a relentless strategic pivot and a fierce multi-front battle for technological supremacy that has genuinely reshaped entire industries. Our mission today is to take a deep dive into an extensive investment analysis report on AMD. Really comprehensive stuff here. We're going to unearth the most important nuggets of knowledge, understand the strategic genius behind their remarkable transformation, and arm you with truly impactful insights into their current competitive landscape and their future trajectory. Think of us as your expert guides, sort of cutting through the noise to give you the clearest, most compelling picture possible.
And this really is more than just, a stock analysis. It's about understanding a company that now sits squarely at the epicenter of some of the most profound secular growth trends of our time. Artificial intelligence, cloud computing, high-performance data centers, the big ones. We'll explore not just how they've survived, but maybe more importantly, why they're thriving now, what their success means for the broader technology industry, and critically, what the major opportunities and, let's be clear, the inherent risks are as they navigate this incredibly dynamic environment. Our goal is for you to walk away with those aha moments, connecting the dots between their strategy, their technology, and these massive market forces at play.
Yeah, exactly. And our primary source for this deep dive is, as I mentioned, a comprehensive equity analysis report. It's a truly rich document, packed with detailed financial data, crucial market share figures, deep strategic insights. It's like having a team of dedicated analysts distill everything for us, and we're here to make sure you get the most actionable, crystal clear understanding from it all. Okay, let's unpack this incredible turnaround because it's really not an overstatement to call it one of the most significant comebacks in recent tech history. Our analysis highlights AMD's astonishing shift from what was once largely a struggling second-source supplier, essentially, living in the shadow of a much larger competitor, to what is now recognized as a formidable leader in high-performance computing. That's not just a leap, it's a complete paradigm shift.
It really is. And the real aha moment of AMD's turnaround wasn't just incremental improvements. It was a complete strategic overhaul, fundamentally driven by exceptional leadership. The report emphasizes the pivotal role of Dr. Lisa Su. Her vision and, frankly, relentless execution, particularly from 2014 onwards, fundamentally reshaped the competitive landscape. She didn't just aim to catch up. She aimed to redefine where AMD played and how it won, directly challenging these long-entrenched incumbents. This wasn't merely about tweaking products. It was about a profound, almost existential strategic reorientation. That repositioned AMD squarely at the epicenter of the industry's most significant secular growth trends, especially within data centers and, of course, the burgeoning field of artificial intelligence. It's a testament to sustained vision, meticulous engineering, and, well, flawless product execution against incredible odds.
So if you had to boil it down, what's the core investment thesis here? What's the big idea behind AMD's current strength that investors are betting on?
The fundamental insight, the core engine driving AMD's current strength, is really their ability to capitalize on, well, an insatiable demand for compute, particularly in AI and data centers. And they do this by consistently delivering leadership-level products. They've expertly executed on three key strategic pillars that really illustrate their multi-front approach. First, there's been consistent CPU execution. Their Zen CPU architecture roadmap, from its initial release in 2017 through successive generations, that has allowed them to claw back significant and durable market share from Intel, and specifically in the highly profitable server and premium client PC markets. This is a direct challenge to decades of dominance, and they did it with a steady, predictable cadence of innovation that frankly restored credibility. Second, they've courageously emerged as the most credible challenger to NVIDIA's near monopoly in AI accelerators, specifically with their Instinct GPU family, and importantly, backed by an open ecosystem software strategy. This is a critical battleground, and AMD is showing early signs of making meaningful inroads. And third, they pursued strategic diversification. The acquisition of Xilinx, for example, is highlighted as a brilliant move to diversify into long-cycle, high-margin embedded markets. This significantly reduces their historical cyclicality and expands their total addressable market, giving them a much more resilient business model overall.
Yeah, that Xilinx move was huge.
Huge! And think about how rare it is for a company to successfully take on two industry giants like Intel and NVIDIA simultaneously and actually gain ground on both. This speaks volumes about their execution, the strength of their technology, and, well, the unwavering conviction of their leadership.
Here's where it gets really interesting on the financial side, because the numbers truly tell a story of transformation. The report describes a profound financial transformation, moving from inconsistent profitability, often plagued by losses, to sustained revenue growth, significant gross margin expansion, and robust free cash flow generation. It's like watching a completely different company emerge.
That's precisely it. And this raises an important question. How did they achieve such a dramatic shift? It wasn't overnight. The report points directly to a dramatic pivot in revenue composition. The high-growth, high-margin data center segment, now representing the majority of sales for the entire company. This wasn't just accidental. It was a deliberate and, frankly, painstaking strategy to de-risk the business from its historical reliance on the more volatile consumer PC and gaming markets. Historically, AMD's financial performance was subject to these extreme swings, dictated by the boom and bust cycles of the PC market and the hit-driven nature of game console launches. By anchoring its business to the data center segment, which is propelled by more durable, long-term capital expenditure cycles of cloud service providers and large enterprises, AMD has fundamentally improved the quality and predictability of its earnings stream. It's a structural change, not merely a cyclical bump, and it supports a persistently higher, more stable valuation for the company.
But even with this incredible success, the report isn't shy about laying out significant challenges ahead. It's not all smooth sailing. What are the big hurdles AMD still faces as it climbs?
You're right, they're definitely facing headwinds. Operating in a fiercely competitive environment against deeply entrenched and well-capitalized rivals like Intel and NVIDIA is always tough. It just drains significant R&D resources constantly. There's also the inherent cyclical nature of the semiconductor industry, which, even if mitigated by diversification, remains a factor. A global economic slowdown, for instance, could still impact enterprise spending, cloud spending, and then there are critical dependencies. Their fabless model, while capital efficient, creates a unique reliance on a concentrated supply chain primarily centered in Taiwan. This exposes them to significant geopolitical risks, a factor that has already shown its teeth, as we'll discuss later. Finally, the stock trades at a premium valuation. Let's be honest. This means the market has incredibly high expectations for future growth and execution. Any missteps in technology delivery or failure to meet those aggressive growth targets could lead to significant stock price volatility. Understanding these risks helps you appreciate the tightrope walk that even the most successful companies in this industry perform every single day. It's a constant battle on multiple fronts.
Okay, let's dive deeper then into how AMD actually makes its money, segment by segment. The company is structured into 4 key business areas, and the analysis makes it abundantly clear there's been a profound and strategic transformation in the company's business mix. It's definitely not the AMD of old.
Precisely. And this reorientation is crucial to understanding their current trajectory and their future potential. The data center segment is now undeniably the primary engine of growth and profitability. That's a deliberate strategic shift from just a few years ago when, client PCs and gaming consoles dominated their revenue. This shift alone tells you a huge part of the AMD turnaround story.
And the data center segment is where the magic truly happens, right? We're talking about products like EPYC, Instinct, Pensando. The report calls it the cornerstone of AMD's growth strategy.
Absolutely. It's the beating heart of their current and future growth. This segment includes their acclaimed server-class CPUs, known as EPYC, their powerful data center GPUs for AI and high-performance computing, the Instinct family, and the data processing units, or DPUs, which came from that Pensando acquisition. We're talking explosive growth here. Revenue reached a record $3.5 billion in Q3 2024 alone. That's a phenomenal 122% increase year over year. Just incredible growth. A huge driver for this has been the rapid adoption of their Instinct MI300 series AI accelerators, coupled with continued market share gains for their EPYC processors against Intel. Critically, the data center segment now accounts for over 50% of AMD's total revenue. That's a pivotal shift from what was a mid-teens percentage of sales back in 2018. This transformation has fundamentally altered the company's financial profile, tying AMD's fortunes directly to the secular growth trends of cloud computing and AI, effectively moving them away from the more volatile consumer markets that once defined them.
Okay, then the client segment, with its Ryzen CPUs. That used to be their core business, the bread and butter, but it's certainly been a bit of a roller coaster ride over the last few years, hasn't it?
It has indeed. It's been subject to the significant cyclicality of the broader PC market. After experiencing a significant downturn in 2023, which saw full-year revenue decline by 25% due to a weak post-pandemic PC market, the segment actually demonstrated a strong recovery. In Q3 2024, client revenue grew a robust 29% year-over-year to $1.9 billion. This rebound was driven by robust demand for their Zen 5 architecture-based Ryzen processors, and interestingly, the initial ramp-up of a new category of AI-enabled PCs. So while it faced considerable headwinds, it's showing resilience and adapting to new market demands.
And then there's gaming, the segment responsible for powering the big game consoles like PlayStation and Xbox. How's that business holding up in the overall portfolio?
This business is undoubtedly strong but highly cyclical, tied directly to the console product refresh cycles, which typically last several years. In Q3 2024, gaming revenue saw a notable decline, 69% year-over-year, coming in at $462 million. This reflects the maturation of the current console cycle, which is now in its fifth year. As consoles age, sales naturally slow down in anticipation of next-gen hardware. While historically a significant part of AMD's revenue, its relative importance to AMD's overall growth narrative has diminished significantly as the data center business has scaled so rapidly. It's now a stable contributor, but it's not a primary growth engine anymore.
Right. Makes sense. The embedded segment, then. This one was significantly expanded by the Xilinx acquisition, and it seems to offer a different kind of stability compared to the others. What's the story here, and what does embedded really mean for you as a listener?
Yeah, this segment is a true diversification play. It provides a broad range of embedded CPUs, GPUs, FPGAs, field programmable gate arrays, and adaptive SoCs for diverse long design cycle markets. These include crucial applications in automotive for advanced driver assistance systems, ADAS, aerospace and defense, industrial automation, 5G telecommunications infrastructure. Think specialized, high-performance chips. They're designed for specific, often mission-critical tasks within these industries. It's currently navigating an inventory correction, which is important context.
Yeah.
Q3 2024 revenue was $927 million, down 25% year-over-year. This correction is basically customers working through excess inventory built up during post-pandemic supply chain issues. But despite this near-term headwind, it provides a source of stable, high-margin revenue that diversifies AMD's businesses away from the traditional, more volatile markets. Makes the overall company far more resilient to economic shifts.
So this dramatic shift in revenue composition across these segments isn't just a coincidence, then. It's a deliberate and profoundly impactful strategy. What does it truly mean for the company's long-term financial health and its future prospects?
This is absolutely critical to grasp. Historically, as we mentioned, AMD's financial performance was subject to extreme volatility, those PC and console cycles, right? By anchoring its business to the data center segment, propelled by these durable long-term capital expenditure cycles from massive cloud service providers and large enterprises, AMD has fundamentally improved the quality and predictability of its earnings stream. That's key. This significantly reduces the company's overall risk profile and, crucially, supports a higher, more stable valuation multiple for the stock, much higher than what would be appropriate for a pure-play consumer hardware company. You can see this vividly in the reports table showing segment revenues and operating income from Q3 2023 to Q3 2024. For instance, data center revenue just soared from roughly $1.6 billion to $3.5 billion. Meanwhile, gaming revenue fell dramatically from $1.5 billion to $462 million in the exact same period. It graphically illustrates this strategic shift and its profound financial impact. It's a complete remaking of their business model.
Okay, let's talk tech. At the heart of AMD's remarkable comeback story is their Zen microarchitecture. It's not just a product line. It's become synonymous with their resurgence. What makes Zen so special, and why was it such a game changer?
Right, Zen. Introduced back in 2017, Zen and its successors have consistently delivered significant, almost unprecedented performance improvements. That's what allowed AMD to challenge Intel's long-held dominance. A key innovation behind Zen is its chiplet-based design. Now, instead of manufacturing one giant, complex, monolithic processor, this approach disaggregates the processor into smaller modular chiplets or dies. This approach is a game changer because it lets AMD mix and match components like CPU cores, I/O controllers, memory controllers fabricated on different, often optimized process nodes. This drastically improves manufacturing yields for large, high core count processors. A defect on one small chiplet doesn't ruin the entire expensive chip you see. It also allows them to scale core counts more cost effectively and bring new, powerful products to market faster than traditional monolithic designs. It's a fundamental architectural advantage that directly fueled their comeback. Their EPYC brand targets the server market, known for high core counts, incredible performance per watt, and superior total cost of ownership. This has been instrumental in gaining that critical data center market share. And Ryzen, including the high-end Threadripper series, addresses client PCs from mainstream notebooks to high-end gaming and content creation desktops, offering compelling performance across the board.
GPUs, graphics processing units, are another critical area for AMD, especially with this explosion in AI. How does AMD's GPU portfolio break down, and how are they tackling the huge challenge of AI?
Yeah, the GPU portfolio is strategically split, really, to address both data center and consumer markets. The Instinct family, that's based on their specialized CDNA architecture, is specifically optimized for data center workloads like AI and high-performance computing, HPC.
Wow.
These are not your gaming graphics cards. They are pure compute engines designed for massive parallel processing. The latest MI300 series accelerators, with their cutting-edge high-bandwidth memory, HBM, are their spearhead into the rapidly expanding AI market, designed to compete directly with NVIDIA's dominant offerings. Then there's the Radeon family, based on their RDNA architecture. That targets the more familiar PC gaming and professional visualization markets, directly competing with NVIDIA's GeForce and RTX lines. So they have this dual approach, with distinct architectures tailored for the very different demands of massive data center compute versus consumer graphics rendering.
And the Xilinx acquisition brought them into this whole new realm, adaptive computing. For us, the listeners, what exactly does adaptive computing mean, and what value does it bring to AMD's portfolio?
Right, adaptive computing. Through the Xilinx acquisition, AMD became a recognized leader in FPGAs, field programmable gate arrays, and adaptive SoCs, or system on chips. These are truly fascinating devices because they're highly flexible, programmable silicon that customers can configure and reconfigure even after manufacturing for specialized tasks. Unlike a fixed CPU or GPU, an FPGA's logic can be customized for optimal performance for specific algorithms or protocols. It's really quite clever. The flagship Versal portfolio takes this a step further, combining traditional CPU cores, dedicated AI engines, and programmable logic all on a single device. This makes it ideal for applications in diverse, long design cycle markets like automotive, particularly for ADAS and autonomous driving, 5G infrastructure, aerospace, defense, industrial automation. It offers a level of customization, flexibility, and real-time processing capabilities that are absolutely crucial for these specialized, high-reliability applications. And importantly for AMD, it provides incredibly stable and high-margin revenue streams.
AMD famously uses a fabless model, which has been a cornerstone of its strategy. For those of us not deep in semiconductor jargon, what does fabless actually mean, and why is it such a critical strategic choice for a company like AMD?
That's an excellent question, and it's fundamental to understanding AMD's business. Unlike an integrated device manufacturer, or IDM, like Intel, which designs and manufactures its own chips in enormous multi-billion-dollar fabrication plants, or fabs, AMD focuses exclusively on the intellectual heavy lifting, the chip design itself. They then outsource the capital-intensive manufacturing process to specialized third-party foundries. This allows them to avoid the multi-billion-dollar capital expenditures required to build and maintain cutting-edge fabs. These can cost upwards of $20 billion each, just think about that. Instead, they can focus their entire R&D budget and engineering talent on innovation and design, rather than being bogged down by the complexities and costs of manufacturing. It's a way to be asset-light in a very, very capital-heavy industry.
And their main manufacturing partner is a truly enormous player in the industry, right? We're talking about TSMC. How crucial has that partnership been to AMD's success?
Exactly. Their main partner is Taiwan Semiconductor Manufacturing Company, TSMC. Undeniably the world's largest and most technologically advanced foundry, this partnership has been absolutely instrumental. It provided AMD access to the industry's most advanced process nodes. We're talking cutting-edge tech like 7 nanometer, 5 nanometer, now 3 nanometer, on a predictable and reliable schedule. This was a decisive advantage, particularly during that period when Intel famously struggled with repeated delays and missteps in its own internal manufacturing roadmap. This divergence allowed AMD to achieve process technology leadership for the first time in its history, really. This strategic choice, leveraging TSMC's manufacturing prowess, helped AMD to not just catch up, but to actually leapfrog its primary competitor in manufacturing technology, which was a huge aha moment and a critical enabler of their entire turnaround.
That's a huge strategic win, effectively leapfrogging Intel in manufacturing. But this reliance on a single partner like TSMC, particularly for the leading-edge nodes, also creates this unique dependency we discussed earlier. Beyond the geopolitical risks, what does this concentrated competition for capacity mean for AMD's long-term ability to innovate and scale? Are they essentially held hostage to TSMC's manufacturing priorities?
That's a critical and nuanced question. While the partnership has been a massive boon, it is a constant battle for wafer allocation. AMD is critically dependent on TSMC for its most advanced products. There's no way around that. Any disruption to TSMC's operations, whether from natural disasters, operational issues, or especially geopolitical events, would severely impact AMD's ability to supply customers. This concentration of manufacturing in Taiwan is, as you noted, a significant geopolitical risk, a major one. Beyond that, AMD must compete fiercely with other massive fabless companies like Apple, Nvidia, even Intel for certain components for access to TSMC's limited leading-edge capacity. This isn't just about money, it's about strategic relationships, long-term commitments, and predicting demand perfectly to secure future capacity. Any miscalculation can lead to product delays, missed market opportunities, or being unable to ramp up production fast enough, even if your chip designs are superior. And this competition extends to advanced packaging technologies like CoWoS, chip on wafer on substrate, which is absolutely essential for assembling high-performance AI accelerators. Think of it as a sophisticated 3D stacking technique. It allows AMD to integrate their GPUs and high-bandwidth memory, HBM, onto a single substrate with incredibly short high-speed connections. This dramatically boosts data transfer speeds and power efficiency paramount for AI workloads. The challenge, of course, is that TSMC's CoWoS capacity is extremely limited, making it a huge bottleneck for scaling AI chip production for everyone, including AMD. And it poses a real challenge to meeting the surging demand we're seeing.
The semiconductor industry is famously cyclical, we know that. Boom and bust periods. What's the current state of play, and what's driving the market right now?
You're right, the industry has a history of significant swings. After experiencing a cyclical downturn in 2023, largely following that unprecedented demand during the pandemic, the industry has entered a robust recovery in 2024, and that's expected to continue strongly through 2025. Projections from major research firms like Gartner suggest global semiconductor revenue could grow by 13.8% in 2025, reaching approximately $717 billion. IDC is even more optimistic, forecasting around 15% growth, so strong growth ahead. This powerful recovery is predominantly driven by surging demand for semiconductors related to AI. The AI megatrend is huge here and a rebounding memory market. In contrast, demand for more traditional sectors like automotive and industrial has been comparatively weaker. This highlights the outsized impact of the AI megatrend in shaping the industry's current trajectory, effectively pulling the entire market upwards.
It's clear AMD is strategically positioned for several incredibly huge markets. Let's look at some of those numbers, because they are, frankly, staggering.
Absolutely. The scale of these markets underscores AMD's strategic pivot. First, the data center and cloud computing market. The global cloud computing market was valued at over $750 billion in 2024, projected to grow at a robust 16-20% compound annual growth rate, potentially exceeding $2.2 trillion by the early 2030s, just massive numbers. This relentless expansion is directly driving demand for server CPUs and accelerators, with the big three cloud providers AWS, Azure, Google Cloud dominating the landscape and setting the pace. Then we have the artificial intelligence, AI, chips market, undeniably the single most significant growth driver for the entire semiconductor industry right now. Forecasts consistently point to explosive growth from approximately $50–60 billion in 2023 to somewhere between $300 billion and $500 billion by the early 2030s. That's a compound annual growth rate well over 30%, just exponential growth fueled by generative AI. The PC market, while more mature, remains a massive volume driver for semiconductors. After a necessary post-pandemic correction, the market is stabilizing. Future growth expected from commercial refresh cycles and, critically, the emergence of the AI PC, a new category with dedicated on-device AI processing capabilities that will likely drive a new upgrade cycle. Finally, the gaming market, a major consumer of high-performance CPUs and discrete GPUs. Hardware sales are cyclical, yes, but underlying trends like cloud gaming, esports, demand for immersive experiences continue to fuel periodic hardware upgrade cycles and new console generations.
It sounds like this isn't just a simple upcycle in the industry. There are fundamental transformative shifts at play that AMD is, well, uniquely capitalizing on.
Precisely. The current semiconductor upcycle is being propelled by several fundamental and profound shifts in technology and computing paradigms. The advent of large-scale generative AI models, like those powering ChatGPT or image generation, has triggered an arms race among corporations and cloud providers to build out massive AI training and inference infrastructure. These workloads fundamentally require the massive parallel processing capabilities of GPUs and other specialized accelerators, creating a new hyper-growth market for AI compute. Secondly, the relentless shift to public and hybrid cloud environments continues unabated. This trend concentrates purchasing power with hyperscale cloud providers who demand the utmost performance, power efficiency, and optimal total cost of ownership, TCO. which has specifically favored AMD's high core count, high efficiency EPYC processors. They hit a sweet spot there. We're also seeing the rise of edge computing. This involves moving inference workloads from centralized data centers to the edge, closer to where data is generated. Think devices like AI PCs, smart cars, industrial robots, 5G base stations. This creates demand for a new class of power-efficient processors with onboard AI acceleration, a market AMD targets with its Ryzen AI and Versal product lines. What's truly fascinating here is that the AI revolution creates demand for entire high-performance systems, not just individual components. AI accelerators need powerful server CPUs to manage data flow, high-speed networking, advanced memory like HBM. AMD is one of only a handful of companies with the intellectual property and product portfolio to supply multiple key components of this high-performance system. This dual-play strategy, offering both leadership CPUs and competitive AI accelerators, is a significant advantage. It allows them to capture value across the entire AI server architecture, not just a piece of it.
And we absolutely can't ignore the broader global stage, can we? Semiconductors are increasingly right at the center of geopolitical competition and national security concerns.
Indeed, the global stage plays an enormous role. The U.S. government has explicitly identified leadership in advanced semiconductors and AI as a national security imperative. This has led to stringent export controls designed to restrict China's access to the most advanced AI chips and manufacturing technology. These regulations directly impact AMD. They've faced a direct revenue headwind and an approximate $800 million inventory charge in Q2 2025 related to its MI308 data center GPU products that could no longer be shipped to China. This has forced AMD to develop specialized, less powerful products specifically for the Chinese market, introducing a significant layer of regulatory uncertainty into its business. In response to perceived supply chain vulnerabilities and, frankly, to regain technological independence, governments in the US, Europe, Japan have launched ambitious industrial policy initiatives, like the US CFTS Act. These programs incentivize domestic fab construction and semiconductor R&D. While they primarily benefit IDMs and foundries, this signals a long-term trend toward a more geographically diversified and potentially more fragmented global semiconductor supply chain. This isn't just business news, it's a stark look at how global politics and national security imperatives directly shape the technology we use every day and the companies that build it.
AMD operates in a market with some truly massive, well-established players. It's not just one rival, but several. Who are their main competitors across these different battlegrounds?
You're absolutely right. It's a multi-front war. First, there's Intel Corporation, their historical and primary rival in x86 microprocessors for PCs and data centers. We all know Intel. Intel dominated for decades, but faced significant challenges in recent years with those manufacturing delays, which crucially created AMD's opening. Intel is now executing a massive turnaround strategy known as IDM 2.0 to regain its manufacturing and technology leadership. They're fighting back. Then we have NVIDIA Corporation, the dominant force in discrete GPUs and the undisputed leader in the AI accelerator market. NVIDIA's advantage isn't just its high-performance GPU hardware, but maybe more importantly, its proprietary CUDA software platform. CUDA is mature, feature-rich, widely adopted. It's become the de facto industry standard for AI development. Creating a powerful software moat with high switching costs for customers and developers, it's sticky. As of Q1 2024, NVIDIA held an estimated 88% share of the discrete GPU market, just dominant. Finally, there's Qualcomm and other ARM-made competitors. In client PCs, AMD and Intel face growing competition from ARM-based processors like Qualcomm's Snapdragon X Elite and Apple's M-series Silicon. These offer compelling advantages in power efficiency and battery life, especially for laptops. And in data centers, cloud providers like Amazon with their Graviton chips and Microsoft are developing their own internal ARM-based server CPUs to optimize for specific workloads, representing a long-term architectural threat to the x86 ecosystem.
So it's not a single battle, but yeah, a multi-front war, with AMD standing varying across these different segments, each requiring a tailored strategy. Let's start with what was perhaps their most historic breakthrough. The CPU battle against Intel. The Zen CPU architecture was the game changer here, wasn't it?
It was, without a doubt, a historic inflection point. Before Zen debuted in 2017, Intel held a near monopolistic position in x86 CPUs, particularly in the lucrative server market where its share exceeded 99%. Just incredible dominance. AMD's innovative chiplet design, combined with the manufacturing prowess of its partner TSMC, allowed its EPYC server processors to deliver a superior combination of core count, performance, and power efficiency compared to Intel's offerings at the time. This technological leadership has translated into a dramatic and sustained sustained shift in market share. In server CPUs, AMD's unit share climbed from virtually zero in 2017 to 24.2% as of Q3 2024. Analyst projections suggest AMD's revenue share could reach as high as 36% by 2025. Critically, AMD's revenue share is significantly higher than its unit share, showing they're winning in the highest performance, highest margin tiers with premium priced products, fundamentally breaking Intel's historical pricing power in those segments. In the client PC market, the story is similar. Desktop share reached 28.7% in Q3 2024, up nearly 10 points year over year, and laptop share was 22.3%. The by86 CPU unit market share table in the report clearly illustrates these shifts from Q3 2022 to Q3 2024, demonstrating a genuine rebalancing of the by86 duopoly.
Now let's pivot to what feels like their toughest fight, the AI accelerator war against NVIDIA. NVIDIA's CADA ecosystem is a truly formidable challenge, almost a religious following for developers.
It's an immensely steep climb, you're absolutely right. NVIDIA's CDA software ecosystem has been the industry standard for parallel computing for well over a decade, creating a deep and sticky moat that is incredibly difficult for competitors to breach. AMD's strategy to challenge this dominance is two-pronged. First, it aims to deliver compelling leadership-level hardware with its Instinct MI series GPUs. The MI300X accelerator, for example, offers industry-leading memory capacity at 192 gigabytes of HBM3 and bandwidth, which is crucial for running the largest and most complex generative AI models efficiently. Huge memory helps. Second, AMD is championing an open software ecosystem with its ROCm platform. By offering an open-source alternative to NVIDIA's proprietary CAD, AMD hopes to attract large cloud customers and enterprises who are increasingly wary of being locked into a single vendor's ecosystem, especially given the scale of their AI investments. Early results are promising. AMD has secured major design wins for the MI300X with top-tier cloud providers like Microsoft, deploying them for Azure public cloud instances and internal workloads like GPT-4 and Copilot services. Meta is using MI300X for inference workloads for its Llama family of models, and Oracle has also become a key cloud customer. These high-profile deployments provide critical validation for both the hardware's performance and the increasing maturity of the ROCm software stack. It shows it works at scale. However, despite this strong early progress, the competitive challenge remains immense. As of Q1 2024, AMD's share of the discrete GPU market stood at 12%, while NVIDIA's surged to 88%. You can clearly see this in the discrete GPU unit market share table from John Peddle Research. While this metric includes consumer gaming cards, it serves as a reasonable proxy for the broader competitive landscape in GPU-based compute and illustrates the sheer scale of NVIDIA's entrenched lead.
So, given all this fierce competition and the incredible technological arms race, what are AMD's true competitive advantages, their moat, if you will, that will sustain them against these giants moving forward?
The report identifies several key advantages that form AMD's competitive moat. First, architectural innovation. The chiplet-based design of both the Zen CPU and CDNA GPU architectures is a core technological differentiator. It provides a scalable, flexible, and cost-effective platform that allows AMD to bring new, high-performance products to market efficiently and with greater yield. That design philosophy is key. Second, their fabless model and TSMC partnership. AMD's close, long-standing relationship with TSMC gives it consistent access to the world's most advanced and reliable semiconductor manufacturing processes, a critical advantage that allows it to focus its precious R&D resources almost entirely on chip design rather than fab maintenance and operation. And third, portfolio breadth. AMD is truly unique in its ability to offer a full suite of high-performance computing solutions, including leadership CPUs, competitive GPUs, adaptable FPGAs, and networking DPUs. This allows the company to engage with hyperscale cloud customers and large enterprises on a system level, optimizing the entire data center stack and offering integrated solutions. That's something competitors with narrower portfolios simply cannot match. This system-level approach could prove to be a significant long-term differentiator in the AI era.
Looking at the numbers from, say, 2018 to 2023, the report truly highlights the sheer magnitude of this transformation under Dr. Lisa Su's leadership. This wasn't just improvement, it was a complete financial resurrection.
Absolutely. In the years preceding the introduction of Zen, AMD faced significant financial distress, characterized by persistent market share losses, uncompetitive products, and often net losses. It was tough times. The strategic decision to pivot the company to focus on high-performance computing and graphics, coupled with the subsequent flawless execution of the Zen product roadmap, created a powerful inflection point. An examination of the company's financial results from 2018 to 2023 really reveals the true scale of this transformation. Annual revenue surged from a mere $6.48 billion in 2018 to $22.68 billion in 2023. That represents an astonishing compound annual growth rate of 28.4%. Phenomenal growth. This period of hypergrowth was fueled by the rapid adoption of Ryzen CPUs in the client market and, more significantly, the successful penetration of EPYC CPUs into the data center. A key indicator of AMD's improved competitive positioning and richer product mix is the dramatic expansion of its gross margin. On a non-GAAP basis, gross margin expanded from 39% in 2018 to 50% in 2023. That's an incredible 1,100 basis point improvement. Almost entirely due to the strategic shift in sales towards higher value, higher margin data center and premium client products. This powerful combination of strong revenue growth and margin expansion has driven a dramatic improvement in overall profitability. Non-GAAP net income grew from $514 million in 2018 to $4.30 billion in 2023. The key financial metrics annual table from 2018-2023 in the report provides precise figures for revenue, gross profit, net income, underscoring the truly monumental scale of this turnaround.
This financial success, then, isn't just a stroke of luck or market timing. It's inextricably linked to consistent, almost flawless product delivery and engineering excellence, wouldn't you say?
Absolutely. AMD's financial success is, as you say, inextricably linked to its management's exceptional track record of product execution. The consistent, on-time delivery of successive generations of the Zen CPU architecture, from the original Zen to Zen 2, Zen 3, Zen 4, and now Zen 5, has been the bedrock of the company's resurgence. Each new generation delivered significant and predictable improvements in performance and efficiency, which allowed AMD to build immense credibility and trust with customers, particularly in the demanding data center market, where reliability and roadmap predictability are absolutely paramount. This steady cadence of innovation stood in stark contrast to the execution challenges faced by its primary competitor, Intel, which experienced those significant delays and missteps in its own manufacturing for years. This divergence created the strategic window for AMD to establish durable technology leadership, which it has successfully translated into significant market share gains and ultimately that financial success. The leadership team, spearheaded by Dr. Su, demonstrated not only deep market understanding, but also a clear strategic vision and an unwavering commitment to engineering excellence that permeated the entire organization.
Now let's bring our attention to the most recent developments, particularly from 2022 to 2024. The biggest story, without a doubt, is AMD's explosive emergence in the AI accelerator market, especially with the Instinct MI300 series. How significant has this been?
The launch of the MI300 family in late 2023 was a monumental milestone for AMD, yes, and it was met with exceptionally strong market reception and a rapid and substantial ramp in demand. This is best illustrated by management's successive upward revisions to its revenue forecast for data center GPUs. At the beginning of 2024, the company initially guided for over $2 billion in AI chip sales for the year. This forecast was raised multiple times throughout the year, most recently to over $5 billion in October 2024. This series of significant guidance increases signals incredibly robust demand and faster than expected adoption by major customers, far exceeding initial expectations. The demand is just huge. These optimistic forecasts are backed by marquee design wins with top-tier cloud providers. Microsoft, for instance, is deploying MI300X accelerators for both its Azure public cloud instances and internal AI workloads like GPT-4 and Copilot services. Meta is using MI300X for inference workloads for its Llama family of models, and Oracle has also become a key cloud customer. These high-profile deployments provide critical validation for both the hardware's performance and the increasing maturity and viability of its ROCm software ecosystem. It signals a genuine challenge to NVIDIA's long-held dominance.
Let's not forget the huge Xilinx acquisition in 2022. It was a massive move. What was the goal there, and how has it played out, especially considering some of the short-term headwinds?
You're right to highlight it. It was a truly transformative acquisition. Valued at approximately $35 billion at the time of announcement, the Xilinx acquisition in February 2022 was explicitly a transformative move designed to diversify AMD's businesses beyond its core PC and data center markets and to establish it as a leader in adaptive computing. It brought a portfolio of high-margin FPGAs and adaptive SoCs, significantly expanding their total addressable market into long-cycle industries like automotive, industrial, communications, aerospace. While strategically sound in the long term, the integration did bring near-term financial headwinds, no doubt about it. The embedded segment, which primarily consists of the former Xilinx business, experienced a cyclical downturn throughout 2023 and into 2024 due to significant inventory corrections, customers working through excess stock. Also, the acquisition resulted in a significant increase in non-cash amortization expenses on AMD's GAAP financial statements, which depressed reported GAAP earnings and made profitability look lower than its operational performance for a while. Despite these near-term headwinds, however, the long-term strategic rationale remains compelling. It provides AMD with a broader, more resilient, and higher-margin business model.
So it sounds like this period wasn't without its bumps in the road outside of the AI excitement. They had to navigate some challenging market conditions simultaneously.
That's absolutely true. While the AI segment was soaring, other parts of the business faced significant challenges. The company's client and gaming segments faced a severe cyclical downturn in late 2022 and throughout 2023 as demand for PCs and game consoles corrected sharply from their pandemic-era highs. This led to a substantial inventory overhang in the distribution channels. AMD managed this downturn by strategically reducing shipments to allow the channel to clear that excess inventory. It impacted short-term revenue, but crucially maintained pricing discipline and avoided a race to the bottom. Thankfully, these markets have since begun to recover in 2024. Furthermore, U.S. government restrictions on the export of advanced AI technology to China created a direct headwind for AMD's data center GPU business. The company has been unable to ship its highest performance MI300 series products to this key market, leading to lost revenue opportunities, and that approximate $800 million inventory charge in Q2 2025 related to MI308 products. This has forced AMD to develop specialized, less powerful products specifically for the Chinese market and has introduced significant regulatory uncertainty into its business. Shows the complex challenges beyond just tech.
Looking ahead, the data center clearly remains AMD's biggest play for sustained growth. What's the plan to keep expanding there, especially as competition heats up?
The strategy is comprehensive and twofold. They aim to continue gaining server CPU share from Intel and simultaneously establish a significant presence in the rapidly expanding AI accelerator market against NVIDIA. The continued execution of the EPYC product roadmap is paramount. The upcoming Turin family of processors, based on their new Zen 5 core architecture, is expected to extend AMD's leadership in performance, core density, and power efficiency. Offering an easy upgrade path for existing cloud and enterprise customers, consistency is key. But AMD is thinking beyond just components. They're moving towards offering more integrated system-level solutions. The planned Helios rack-scale platform, for example, will integrate EPYC CPUs, Instinct GPUs, and Pensando networking hardware into a pre-validated system designed specifically for large-scale AI workloads. This approach simplifies deployment for customers, reducing complexity and time to market for AI infrastructure, and critically allows AMD to capture more value from each server socket by selling an integrated solution rather than just individual chips.
This AI market opportunity is truly the cornerstone of their long-term growth, and the numbers we see for AI chips are just staggering. What's AMD's detailed strategy to capture a meaningful slice of this rapidly expanding pie?
Management estimates the total addressable market, or TAM, for AI accelerators could reach an incredible $400 billion by 2027. Whether it hits that exact number or not, the opportunity is undeniably massive. Even a modest 10-15% share would represent a monumental revenue opportunity for AMD, potentially adding $40-60 billion to its annual top line. Just huge potential. To achieve this, AMD is pursuing a multi-pronged strategy. First, they're committed to an aggressive annual product cadence for Instinct AI accelerators. MI325X in late 2024, the next-gen MI350 series based on CDNA4 in 2025, and the MI400 series for 2026. This directly challenges NVIDIA's rapid pace of innovation and ensures a continuous stream of competitive hardware. Second, a key differentiator is their commitment to an open hardware and software ecosystem. Their RSCM platform is an open-source alternative to NVIDIA's proprietary CDA, specifically designed to appeal to large cloud customers and enterprises who want to avoid vendor lock-in and foster greater flexibility. On the hardware side, AMD is a founding member of the Ultra Accelerator Link, or UA Link, consortium, which aims to create an open industry standard for connecting AI accelerators, directly challenging NVIDIA's proprietary NVLink interconnect. This open versus proprietary battle is a crucial dynamic to watch in the AI space, and AMD is firmly on the side of open, betting that an open ecosystem will ultimately win broader adoption.
While the data center and AI are clearly the central focus, what's happening in their other segments, gaming, client, and embedded systems, to drive continued innovation and growth?
AMD continues to pursue significant growth opportunities across its other segments as well, absolutely. In gaming and graphics, AMD is preparing to launch its next-generation RDNA 4 graphics architecture in early 2025, which will power a new family of Radeon GPUs. The strategy here seems to be offering compelling performance at mainstream price points, focusing on value and performance per dollar to gain share in that large volume market. For AI PCs, AMD was a pioneer in the category, being the first to integrate a neural processing unit, NPU, into its x86 processors. The latest Ryzen AI 300 series processors offer up to 50 TOPS trillions of operations per second of NPU performance, positioning them as a leader in the next wave of AI-enabled notebooks from partners like HP, Lenovo, ASUS. These will offer new on-device AI capabilities. And in automotive and embedded, leveraging the broad portfolio acquired from Xilinx, AMD is targeting high-growth opportunities in the automotive sector for ADS and autonomous driving, industrial automation, and 5G infrastructure with its adaptive SoCs. These specialized solutions provide long-cycle, high-margin revenue streams that significantly diversify the business and offer a buffer against cyclicality in other markets.
The report painted a picture of AMD's financials moving from, well, weakness to real strength and stability. What does their balance sheet look like now, and how strong is their financial position?
As of the end of the third quarter of 2024, AMD's balance sheet is exceptionally robust, really strong. They held approximately $4.5 billion in cash, cash equivalents, and short-term investments against a manageable $2.5 billion in principal debt, resulting in a very healthy net cash position, more cash than debt. Their debt-to-equity ratio is exceptionally low at just 0.0651, indicating very minimal financial leverage and high solvency. This strong balance sheet provides AMD with significant financial flexibility to navigate any future industry cycles, fund its aggressive R&D roadmap, and pursue strategic opportunities like tuck-in acquisitions as they arise without undue financial strain. It's a stark contrast to their financial position a decade ago, just night and day.
And cash flow generation has improved just as dramatically, wouldn't you say? It's one thing to show revenue, it's another to convert that into real cash.
Absolutely. It's a critical indicator of business quality. AMD has become a powerful and consistent generator of free cash flow, hitting a record $1.2 billion in Q2 2025. This ability to convert a significant portion of its earnings into cash is a hallmark of a high-quality, sustainably profitable business model. This strong cash flow is sustainable because it is primarily driven by the profitable growth of the high-margin data center segment. The company's fabless model, which outsources capital-intensive manufacturing, also allows it to maintain relatively low capital expenditure requirements, further bolstering its free cash flow conversion, and maximizing the cash available for strategic investments or shareholder returns.
How is management putting this financial strength to work? What's their capital allocation strategy, and what does it tell you about their priorities?
Their approach is thoughtful and strategic, reflecting a company focused squarely on long-term growth. The primary use of capital, as you'd expect for a technology leader, is research and development, R&D. This is the lifeblood of a company like AMD. They've significantly increased R&D spending to fund the parallel development of their ambitious CPU, GPU, and AI accelerator roadmaps, as well as to build out their crucial software capabilities like ROCm. For strategic acquisitions, the Xilinx deal was a major all-stock transaction, a prudent use of AMD's highly valued equity at the time to acquire a high-quality strategic asset without taking on significant debt. Smart move. More recent, smaller tuck-in deals, such as Pensando, Nod.ai, Silo AI, have been designed to acquire specific technologies or talent to bolster AMD's capabilities in data center networking and AI software. A targeted approach. AMD also has an active share repurchase program, which it uses to return capital to shareholders and to offset the dilutive effect of stock-based compensation. They had $4.9 billion remaining on authorization as of Q3 2024. Finally, on dividend policy, AMD currently does not pay a dividend. The company's policy is to reinvest all of its free cash flow back into the businesses to fund its significant growth opportunities. A strategy that is entirely appropriate for a company in its high-growth phase, prioritizing future expansion over immediate shareholder payouts.
That gross margin expansion we talked about earlier, from 39% to 50%, that's a huge jump. Can they keep that up, or is there a ceiling to how high those margins can go?
The trajectory of AMD's gross margin is a critical indicator of its competitive strength and pricing power. The company's non-GAAP gross margin has expanded dramatically from the low 40s to a target of approximately 54% for the fourth quarter of 2024. The primary driver of this expansion has been the significant shift in product mix. It really comes down to that. As the high-margin data center segment with its premium-priced EPYC CPUs and Instinct GPUs has grown to become the majority of the company's revenue, it has naturally lifted the overall corporate average margin. The sustainability of these higher margins depends on continued market share gains and sustained technology leadership in the data center, and the profitability of the new Instinct AI accelerators, which management indicates are accretive to the corporate average margin over the long term. They should help, not hurt. Potential headwinds include intense price competition from Intel in the client market, particularly as Intel attempts to regain share, and the structurally lower margins of the consumer-focused gaming console business. However, as long as the data center segment continues to outgrow the other parts of the business and AMD maintains its technology edge, the current high 50s gross margin profile appears sustainable and has the potential for further modest expansion.
Okay, despite all this incredible progress and financial strength, the semiconductor industry's cyclical nature can't be entirely escaped, can it? It feels like a fundamental truth of the market.
You're absolutely right. It's a persistent underlying reality. The semiconductor industry is historically prone to significant boom and bust cycles, driven by fluctuations in supply and demand, rapid technological change, macroeconomic conditions. It's always there. While AMD has strategically reduced its exposure to the most volatile consumer segments by pivoting its business towards the data center, a broad global economic downturn would still negatively impact enterprise and cloud spending, affecting demand for AMD's products across the board. The recent inventory corrections in the PC and embedded markets in 2023 serve as a clear, recent reminder of this persistent cyclical risk. Even the strongest companies can't entirely avoid it. It just means the troughs might not be as deep as they once were, but they can still be painful.
AMD's success has been built on an almost flawless execution of its product roadmaps. What happens if that incredible execution falters, even slightly? What are the technology execution risks here?
The semiconductor industry is famously unforgiving of missteps, especially at the leading edge. The pressure is immense. AMD's continued success is fundamentally predicated on its ability to consistently execute its ambitious product roadmap and maintain its technology leadership against incredibly well-resourced competitors. Any delays in the development or launch of future product generations, or a failure to deliver expected performance gains that live up to the hype, could quickly cede competitive advantage back to rivals like Intel or NVIDIA. They are engaged in a high-stakes R&D race against these giants, both of which have substantially larger research budgets. Therefore, flawless execution is not just an advantage, it is a necessity for survival and continued success in this hyper-competitive industry. The margins for error are incredibly thin.
And speaking of those giants, AMD is still up against some serious heavyweights. What does the competitive pressure look like moving forward, particularly as Intel aims for a comeback and NVIDIA solidifies its AI lead?
Intense competition is a constant, relentless force across all of AMD's business segments. It never lets up. Intel remains a formidable competitor in the data center and client CPU markets, with immense scale, deep customer relationships, and a renewed focus on regaining manufacturing leadership through its aggressive IDM 2.0 strategy. This means AMD needs to continually innovate just to maintain its hard-won market share. In the AI accelerator market, NVIDIA holds that dominant market position, fortified by its powerful CAD software ecosystem, which represents a significant barrier to entry for AMD's RSCM platform. Convincing developers and enterprises to switch or at least embrace an alternative is a massive undertaking. It takes time and proof. Furthermore, the emergence of ARM-based processors from competitors like Qualcomm and from internal design teams at major cloud providers like Amazon's Graviton represents a long-term architectural threat to the x86 ecosystem, adding yet another layer of competitive pressure and requiring AMD to remain agile and innovative.
We've touched on the fabless model's reliance on TSMC, and it seems like a particularly critical point in the risk profile. Can you elaborate on the supply chain vulnerabilities there?
Yes. AMD's fabless business model, while capital efficient, creates a critical dependence on a small number of third-party partners. They rely almost exclusively on TSMC for the production of its most advanced chips, which concentrates a huge portion of its manufacturing in Taiwan. This region, unfortunately, is one of significant geopolitical tension, that's putting it mildly. Any disruption to TSMC's operations from a major earthquake, a power outage, or, God forbid, a geopolitical event would have a catastrophic impact on AMD's ability to supply its products globally. Additionally, AMD must fiercely compete with other large technology companies like Apple and NVIDIA for access to TSMC's limited leading-edge manufacturing and advanced packaging capacity. Shortages in critical packaging technologies like CoAS, which are absolutely essential for their high-performance AI accelerators, can act as a significant bottleneck on growth, limiting AMD's ability to scale production to meet surging demand. It's a constant battle for resources in a very tight supply chain.
And the broader geopolitical stage continues to loom large over the entire semiconductor industry. It feels like a constant shadow, doesn't it?
It absolutely does. The semiconductor industry is at the very center of global geopolitical competition, particularly between the United States and China. U.S. government restrictions on the sale of advanced AI chips and manufacturing technology to China directly limit AMD's addressable market and have already resulted in lost revenue and significant inventory write-downs, as we discussed with the MI308 products. The risk of further, more stringent controls remains high, creating ongoing uncertainty and requiring AMD to constantly adapt its product strategy for different regions. Beyond trade and technology, the potential for a conflict in the Taiwan Strait represents the most significant systemic risk to the entire semiconductor industry, and to AMD in particular, given its reliance on TSMC. Such an event would have unimaginable global consequences for technology supply chains and would directly and severely impact AMD's ability to operate. It's a very real and ever-present concern for the company and the whole industry.
AMD's impressive growth and strategic pivot are certainly reflected in its stock valuation. For our listeners, how does it look right now in terms of market multiples? It's not cheap, right?
No, definitely not cheap. As of late 2025, AMD trades at premium valuation multiples, significantly above the broader market and historical averages for a traditional semiconductor company. The trailing 12-month GAAP price-to-earnings, or PE, ratio is elevated, often in the 90-100x range. This largely reflects the impact of significant non-cash acquisition-related amortization expenses, particularly from the Xilinx deal, which can temporarily depress GAAP earnings. Makes the GAAP number look high. A more meaningful metric for operational performance, the forward non-GAAP PE ratio, based on analyst estimates of future operational earnings, is typically in the 40-45x range. Still high, but more reflective of operations. Its trailing 12-month price-to-sales, or PS, ratio is approximately 9x, and the trailing 12-month enterprise value to EBITDA, or EBITDA, multiple is approximately 49x. These are all indicators that the market has very high expectations baked into the price.
How do these numbers stack up against its biggest rivals, NVIDIA and Intel? Does the market differentiate them, and if so, why?
The market absolutely differentiates these companies, yes. The valuation multiples tell a clear story of market perception. NVIDIA, as the undisputed leader in the AI market, commands the highest valuation premium. Its forward PE ratio is around 36x, which actually looks lower than AMD's non-GAAP, but its PS ratio is substantially higher than AMD's at 30x. That's huge. This reflects NVIDIA's much higher gross margins and its dominant market position, especially reinforced by the powerful CDA software moat. AMD's valuation is generally at a discount to NVIDIA's, which the market appears to justify based on NVIDIA's larger market share in AI and the sheer strength and stickiness of that CDA ecosystem. Intel, on the other hand, trades at a significant valuation discount to both AMD and NVIDIA. A big discount. Its PS ratio is around 2.7x, and its PE ratio has even been negative recently due to significant operating losses and its heavy reinvestment cycle for IDM 2.0. This lower valuation reflects the company's slower growth profile, ongoing market share losses, and the significant execution risks associated with its turnaround strategy. The Comparative Valuation and Financial Metrics (TTM) table in the report for AMD, NVIDIA, and Intel provides concrete numbers for market cap, PS, forward PE, EBITDA, revenue growth, gross margin. Makes these differences quite stark when you see them side by side.
So this is the central debate for investors then. Is AMD a traditional cyclical semiconductor company destined for lower multiples eventually, or has it truly transformed into something more? A structural growth story deserving of its premium valuation?
This really is the central debate surrounding AMD's valuation, yeah. And it's where different investment theses diverge. Historically, cyclical hardware companies, prone to those boom and bust cycles, tend to trade at much lower multiples, typically 10-20x PE, to account for the inherent volatility of their earnings. High-growth technology platform companies, however, especially those with strong competitive advantages, can sustain much higher multiples because their growth is seen as more predictable and durable. The bull case for AMD rests firmly on the argument that the structural shift in its business mix towards the data center, driven by the powerful secular trends of cloud and AI, has fundamentally de-risked the company from its historical cyclicality. This structural change, they argue, justifies a persistently higher valuation multiple. It's a different company now. The bear case, conversely, argues that competition and the inherent cyclicality of the industry will eventually lead to a normalization of growth and a compression of its valuation multiples back toward historical norms. Even if those norms are adjusted upwards slightly, gravity always wins, they might say. The stock's future performance will heavily depend on which of these narratives, cyclical or structural growth, proves more accurate over time. It's about discerning the underlying quality and long-term trajectory of the business, beyond just the current headlines and excitement.
Okay, for anyone tracking AMD, whether you're an investor, an industry analyst, or just intensely curious about this space, the report identifies some truly crucial metrics. What should you, our listener, be watching closely to understand if AMD is continuing its ascent?
These are truly the vital signs, yeah. Your dashboard to understand AMD's health and execution. First, data center revenue growth. This is the single most important indicator of the company's success right now. Look for sustained, high, double-digit year-over-year growth quarter after quarter as evidence that AMD is successfully executing on its AI and server CPU strategies. That's number one. Second, closely monitor the gross margin trajectory. Track the non-GAAP gross margin for signs of pricing power, product mix shifts, competitive pressures. Sustaining or expanding mid-50% margins would be a strong positive signal. Any significant or sustained compression would be a major red flag. Third, instinct GPU revenue and customer wins. These are direct, tangible proof points of progress in the AI market. Watch for specific management commentary on quarterly revenue contribution from Instinct and public announcements of new design wins with major cloud and enterprise customers. Gotta see those wins. Fourth, for their core server CPU business, server CPU market share from third-party firms like Mercury Research is essential. Gauge whether AMD is continuing to gain or at least hold its share against a resurgent Intel. Can't take your eye off that ball. Fifth, keep an eye on R&D as a percentage of revenue. Ensure that AMD is investing sufficiently to maintain its competitive edge against larger rivals without letting operating expenses grow out of control. It's a balancing act. And finally, monitoring inventory levels, particularly in the client and embedded segments, provides crucial insight into the health of end market demand and the status of any ongoing inventory corrections in the supply chain. These metrics are your essential dashboard to understand if AMD is executing on its ambitious strategy and delivering on its promise. Hashtag tag tag outro.
Wow, what an incredible deep dive into advanced micro devices. We've truly peeled back the layers on a company that has executed one of the most remarkable turnarounds in technology history, pivoting decisively into high-growth areas like data centers and AI, all while battling formidable rivals and navigating incredibly complex geopolitical challenges. It's quite a story.
The core story here really is AMD's successful and structural shift from what was once a cyclical, consumer-dependent company to a diversified, high-performance computing powerhouse. Their dual-play strategy in leadership CPUs and competitive AI accelerators, combined with that open ecosystem approach, positions them uniquely in an industry being fundamentally reshaped by artificial intelligence. But remember, premium valuations come with equally high expectations, and the competitive and geopolitical risks are very real and ever-present. They haven't gone away.
So as AMD continues its rapid product cadence and relentlessly challenges the titans of the chip world, here's something for you to ponder. In a future increasingly defined by AI, how much value will ultimately be placed on an open, adaptable hardware and software ecosystem like AMD is championing versus the established proprietary walled gardens that others have built? And what does that mean for who truly wins the AI race for the long haul? Keep these insights in mind as you watch the tech landscape unfold. There's always more to learn, and the semiconductor world is never ever dull.